With 30-year treasuries hitting levels that they haven't seen in decades, all eyes are on the bond market as investors try and piece together what this means for their portfolios. Hi, folks. I'm Rick Wedell. I'm the Chief Investment Officer at RFG Advisory, and we wanted to come to you today with a brief market update and kind of let you know what's going on out there. As I mentioned, all eyes on the bond market. 30-year Treasury today is at about 5.2% after topping out just north of 5.3% a little bit earlier. And the 10-year Treasury at about 4.65%, which is not the high for the cycle. Back during the post-COVID interest rate raising days, we got almost all the way up to about 5%. So not the high for the cycle, but certainly a very, very high level. And all investors' eyes are kind of focused on what this is, why this is happening, and where it might go from here. We're going to focus on the sort of second part of this question, which is why is this happening? And there are a number of reasons that are being proffered out there. Probably the most intuitive and the closest in is what is going on with oil prices and the market's anticipation of whether or not we will ever get a resolution to what is going on with the Strait of Hormuz and oil coming out of the Middle East. The market currently betting, and something that I kind of intuitively agree with, that this is a situation that's going to play out over a very long period of time, that we are highly unlikely to see oil prices come down anytime soon. It's been pointed out that Iran has been under U.S. economic sanctions since 1979. So the idea that we're going to put more economic sanctions on them and get a resolution to this crisis seems very, very low. As a result, that means higher oil prices. That means higher inflation, higher prices for people at the gas pump. And then that also means that the Fed may need to lean in to help curb or reduce that inflation. So Treasury markets thinking about potentially, interest rates needing to move higher. The second thing that's going on, which I think is pointed at, is, hey, we as a country are running some of the largest budget deficits we've ever run, in excess of $400 billion in deficit last month, which neither side of the aisle actually seems interested in closing. And so bond investors potentially demanding a little bit more of a premium for U.S. debt in order to actually continue to finance that. It has been pointed out that this is a global phenomenon, that you are seeing interest rates rise across the developed world, Germany, the UK, France, Japan, all of these countries seeing bond yields go up. But this is also a little bit of a substitution effect. If the U.S. Treasury all of a sudden becomes more expensive from an interest rate standpoint, then you might demand a little bit more to invest in, let's say, German bonds or French bonds or bonds from the UK. And so in my mind, there's a little bit of a substitute. As the U.S. bond yields go, so does the global bond yields. And I don't necessarily know that we're going to see this correct anytime soon, given that I don't think what's happening in the Middle East is going to correct anytime soon, and given that I don't think we're going to get the budget deficits under control anytime soon. So I do think you're looking at interest rates that are sort of fundamentally higher for a while. Higher interest rates matter. The 30-year Treasury rate is what you set a mortgage rate off of, so that hurts the housing market. The 10-year Treasury rate is what you think about when you think about a car loan, or more likely a 5 or 7 year, but you get the idea. And most companies, when they're looking at borrowing money, they don't just borrow at floating rate. They borrow with a 5-year duration or a 10-year duration type of interest rate profile. So rising interest rates will impact the curve and impact the cost of borrowing through the economy, which then in turn has the potential to slow down the economy. And that is one of the reasons why you typically don't see equity markets fare all that well in a rising interest rate environment. And right now, all of you are scratching your heads and saying, well, wait a minute, I thought the S&P had done well this year. And you're not wrong. We're up about S&P 500 right at about 77.32 as I'm speaking, up about 12.75% for the year. which is a good year. Do not get me wrong. However, I think it's worth noting to folks that we came into the year at about 4.2% on the 10-year and have risen to about maybe 4.7% at the peak. That's about a 50 basis point move or a 0.5% move. And the equity market reacts somewhat negatively when we moved that 0.5%. That is nowhere close to what everybody remembers from 2022, when we started the year at about 1.5% and ended the year at about 3.5%. That was a dramatic rise in interest rates. This has been much more muted over the course of the year. And so the equity market has been able to sort of hang in there. Assuming that we see rates that kind of level off from here or don't go too much higher, I would expect the equity market to continue to cope with it. But once again, all eyes will be on the Fed and on inflation data and oil prices and everything else, budget deficits, to determine where those yields go. So with that, as always, if you have any questions, please feel free to reach out to myself or to your advisor. Hope you're having a fantastic day, and I look forward to talking to you again soon.